Thank you very much, and welcome to today's webinar being sponsored by Accountancy Insurance, hosted by CPA Australia, Tax and Audit Insurance Claim Trends Affecting Accountants. My name is Kristen Beadle and I'm the Manager for Public Practice and SMA at CPA Australia, and today we have people joining us from all over the country, so welcome. I'd like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. It is now my pleasure to invite Roman Kaczynski, Director of Accounting Insurance, and Rod Spicer, Associate Director for Claims and Underwritings at Accountancy Insurance. Today we'll be taking questions through the Q&A box, and please direct questions to all panelists. We will address questions at the conclusion and we'll do our best with any time remaining. For any troubleshooting queries, please send a message to the host using the chat box. It is now time for our session to commence, and I'll hand over to Roman.
Thank you, Kristen. Hopefully I'm coming through loud and clear here. Welcome again to our annual webinar with CPA titled Tax Audit Insurance Claim Trends Affecting Accountants in Australia. Last year when we did this, almost exactly a year ago to this date, we opened up wearing our masks. Somewhat frustratingly, we sit here now with COVID and the obligatory restrictions still ever present in most of our day-to-day lives. No one has to tell an accountant in practice what the effect of all of this has been and continues to be. In case there may be some people who don't know who we are, Accountancy Insurance runs a tax audit insurance program with accountants called Autoshield. Through the multiple thousands of accountants we work with, we have exposure to around 200,000 client groups, which represents somewhere around 600, 800,000 tax returns and the audit activity around those. This representation is based on working with nearly all the second-tier firms and brands, and also the national network groups, all the way through to lots of small proprietors running their accounting businesses. So with that mix of accountants and the mix of their clients, we believe we have a genuine cross-section of the taxpayer population, and more importantly for this session, a cross-section of what the ATO and the other government revenue authorities are up to. Presenting today, we have, as usual, Rod Spicer and myself, Roman Kaczynski, representing this information. Both Rod and I are ex-public practitioners, so don't hold that against us. Individually, we both have over 20 years experience in practice before we joined Accountancy Insurance and got involved in claim management. Rod's experience comes from the second-tier environment, mine in the smaller practitioner space. We would like to acknowledge the great relationship we have with CPA Australia, and we are their official national tax affiliate. We thank them for the opportunity to present this information to the membership. So if you have any questions, please, as mentioned already, please type them in the questions section, which should be on the right-hand side of your screen. If we get a chance, we'll look at them and answer them on the fly, but in any event, we'll try and answer them at the end. So today's session, we're going to be looking at a little bit of what we've seen. So most frequently claim types we've seen and who we've seen has been targeted. And also we want to spend a little bit of time talking about what we think is going to happen going forward in employer obligation space, JobKeeper space, the next 5,000 program that's being run, and anything other significant activity and targets that we see. But before we start, we want to run a couple of polls throughout the webinar. Firstly, to try and make this a little bit interactive, but also to get a sense of whether you're actually watching this webinar and not the Olympics on your 7+ app on the other screen. So the first poll question is, what do you estimate is the most frequent ATO and state revenue authorities audit type, as noted by our claims team from the 2021 financial year? So we've got a choice of A, being BAS audit and reviews, and that includes cash flow boost, JobKeeper payments, audits and reviews, employer obligation audits, and reviews, including superannuation guarantee inside there, payroll tax investigations, and income tax, full, general, and combined. So the bigger audits, if you like. So that's the poll question. Off you go. See if you can. What do you think it's going to be? But in the meantime, talking about while we're waiting for those poll results to come in, Rod, just for those who may have been wanting to watch the Olympics, can we break the news that Ariana Titmus had won gold at the 400 metres?
Yes, absolutely. It was great timing. Just as we came live on screen, it finished. So good to get a gold.
Yeah, good to get a gold there. And we got I think it was a bronze earlier on this morning as well. So, and Steph Gilmore's out of the surfing.
Surfing, is he? In the Olympics?
There is surfing. Who would have thought? Who would have thought? No, there's skateboarding as well. Okay, so we're just waiting for those results to come through. They shouldn't be too far away. Okay, so we can probably proceed. Well, they'll show up on the side there. Time limits expired, and waiting for those. Here we go. The results are coming through.
No answer.
Income tax. What do we got there? So okay, that's a reasonable spread inside there with and the Olympics distraction, I think, is winning out on that result. What do you reckon?
I'm happy with that. It's a gold medal for watching the Olympics, I think. So,
Okay,
fair enough. That's all right.
Okay, so let's move on to things. So okay, let's get started. Look at it and bring Rod. You can start into the conversation. So Rod, we annually put together a summary of what we see as the frequent audit types. We can see what our audience thinks, but what is this year's results looking like for you?
Yeah, so I mean, the financial year to 30 June 21 is, I think it's safe to say, was unlike no other that we had ever seen in our lifetime as accountants working in the profession. I mean, we were at 30 June 2020, we're only sort of one quarter into the whole COVID landscape, and no one knew where we were going to land. I think we all hoped it would all be finished, but it isn't, it's not, and we soldiered on. And that had a massive impact on the audit landscape in Australia last year. And I think it's fair to say that for a fair portion, let's call it 6 months from June to December, a lot of the state revenue authorities and the ATO pulled right back on audit activity, certainly through to about October. So there was not your normal traditional audit activity going on, but we found new things being audited, all off the back of COVID. Cash flow boost, which was GST BAS returns being audited, JobKeeper payments being audited. So things that were never there before and may never be there again, filled 2 of the top 5 places effectively in 2021. But in this second half up to June, we saw the state revenue authorities recommencing their payroll tax activity. We saw the ATO restarting superannuation guarantee audit activity. We saw things like the next 5,000 high wealth individual audit program by the ATO. So to put it in a nutshell, as I've said many times, someone has to pay for all these government subsidy programs that have been going on. And I think one of the levers that has been pulled in the second half of the year and will continue to be pulled is audit. They won't come out and say it because it might be politically insensitive, but I think behind the scenes, we're seeing normal audit activity back in vogue, I think is fair to say.
So what is that? Let's go through and look at that from a graph perspective.
Yeah. So what we saw was, and if we round out things, we saw about 20% of our total audit and claims activity coming out of BAS activity statement audits, which were predominantly cash flow boost. There was a lot of ATO audit activity on cash flow boost. They certainly didn't just pay it without doing some checking of the employer and what they were claiming. And it was pretty easy to see that what got stopped, reviewed and audited were items on a BAS at W1 and W2 that were way outside the norm of that business and what they had previously reported. People actually trying to register for PAYG for the first time ever in the March, June and September quarters. They were pretty much pulled up straight away. So there was a lot of audit activity around large wholesale variations in numbers on BASs in the wage area to what have been claimed previously. Also drop in turnover and things like that all came into play. So, and things like that. So that was why that ended up number one. Number two was employer obligation audits, which were mainly around the superannuation guarantee space. It's still a key focus area. I think if we looked at last year, that was our number one claim category, but with the other new categories, if you like, cash flow boost and JobKeeper, this last financial year, it moved into number two. And then we still saw payroll tax still creating basically 10% of our claims, income tax nearly up to 10% as well. Plus we have JobKeeper, you know, just rounding up, if you like, to also about 10%. So that was the highlights of the year, but we still saw lots of activity in rental property space, 5% of our claims, and a whole smattering of smaller income tax categories, which if you added them all together, was still a significant amount. So we still saw a lot of audit activity, even though there was a lull for a few months. It certainly came back in the back half of the year for us.
So let's reflect back a little bit to see how last year looked, what the graph looked like for last year. So as you said, Rod, the number one last year was our employer obligations audit, and that's dropped back to being number two on the back of, as you mentioned before, the cash flow boost forming inside the BAS reviews there. Yeah, so payroll tax was still big last year, but I think my observation, Rod, and you may have your own, but these numbers have shifted predominantly to allow the new items to come in.
Absolutely. Yeah. Yeah. I would expect the 2022 financial year to look more like the 2020 financial year, purely off, well, cash flow boost is gone. It's not there anymore. JobKeeper, well, is there ever going to be a JobKeeper 3? Well, they keep saying no. Well, let's hope there isn't, because that means things are better. So, so I'm not expecting JobKeeper to be a top ranking category. They're still getting some audits there, but not as much as there was up to March and April, that's for sure, but it's still being audited.
Okay, so let's now have a bit of a deeper dive into the top five, and starting with our this year's number one, our gold medal winner, if you like, to keep the Olympic theme happening, BAS audits and reviews.
I probably stole a bit of my own thunder. I already sort of answered or spoke about what's actually on this slide and what was attributed to being that number one, and it was cash flow boost. So, and that crackdown by the ATO on eligibility for amounts being claimed by employers. I mean, cash flow boost was a rather unique example of rules on the run. It the effect of COVID on your business had zero effect on whether you're entitled to the cash flow boost. So all the businesses that actually COVID was a gold mine still received up to $100,000 in cash flow boost payments. So there was no criteria per se about eligibility. Every employer business got cash flow boost. So as I said, we saw a lot of reviews on eligibility, crackdown on variations in higher wages being claimed than previous. You know, I could go on with some rather bizarre stories that I saw on things that were being claimed as wages in that 3-quarter period when cash flow boost was in. But in the main, it was there for that 3 quarters that cash flow boost was payable in, and then it sort of died off. But I'm still seeing a few, which I'm attributing to people, employers that didn't lodge their BASs for those 3 quarters in COVID and are catching up now, because even last week I saw a claim and I'm scratching my head going, well, I must just be lodging the BASs now to be audited. So there's still, and that could easily be, that's the reason I'm attributing it. So, but I think if anyone tried to lodge an amended BAS with different W1, W2 figures, you'd have zero chance of that going straight through to the keeper.
I think it'll be pinned up. We'll see it come past out there.
Yeah, that's right.
Okay, so moving on to this year's silver medalist, and it was previously our most popular claim for the last 3 years, employer obligation audits.
And I think anything to do with employer obligation audit, and that can be superannuation guarantee, your work cover, your payroll tax. in days gone by, when Rome and I were in public practice, we said, "Yep, we'll do your payroll, we'll do your work cover, we'll do your payroll tax returns." As the clients sort of came in the door, it was a great selling point. But I think it's fair to say that accountants have backed off from doing the payroll of their clients these days because it's too risky from various angles, PI being one, etc. So I don't think accountants do as much payroll for their clients as they used to. But that then makes it the most frustrating type of audit activity because you don't see what your clients are doing. Are they paying the correct super? Are they filling in the work cover return correctly? Are they completing the payroll tax returns correctly on a monthly, quarterly, annual basis? You're not doing it. You don't see it. So when the audit comes, the client will probably still say it's your fault, even though you had nothing to do with it, because that's just the traditional, it's always the accountant's fault. But these audits are frustrating because you're not in control of what's going on. And in many cases, the accountant's left to clean up the pieces, clean up the mess quite often of what has or hasn't happened, and has to come into bat for their client and try and quite often negotiate a position. And super guarantee is a key focus area of the ATO and the government. There is billions of dollars in unpaid super out there for many, many years. And the ATO is not just going to let it go, because at the end of the day, what doesn't end up in your superannuation account could potentially be additional pension payments that the government's going to have to fund on the retirement to top up people's income post-retirement. So it's a key focus area. And one of the key drivers of single touch payroll is this now constant reporting to the ATO by employers. So the ATO now knows if an employer hasn't paid their super guarantee by the due date, because the reporting is going up the line automatically as part of the payroll reporting. And super guarantee activity is going to be, we'll see it in our predictions later, but I'd be shocked if it didn't return to #1 this financial year.
So looking at our bronze medalist, if you like, and it's we talked about that we're accumulating all the payroll tax states all together for the purposes of this, but also touching on what you just said before about the payroll and the accountants not necessarily being in control. One thing of how many times have we seen claim audits come up where people have been challenged on the fact that they should have been registered for payroll tax and weren't, and how often is that the case that the accountant doesn't know that the payroll has gone beyond a certain level throughout the year and find out later? And going back to your point, it's the accountant's fault somehow that they didn't, they're not tracking the payroll throughout the year for that purpose.
And it's an easy win for the state revenue authorities, because they're getting their data from the PAYG STP information that's being fed up into the ATO, or the work cover returns, and all those government agencies and revenue authorities share their data. So anyone who thinks that the State Revenue Office doesn't receive the gross payroll numbers of all employers is kidding himself, because it's just an auto feed, I think, probably about this time of the year, because I think all employers have got till this year, 31 July, to finalise their PAYG reporting. So I reckon 1 August, the button gets printed or pushed to send the data over to the state revenue authorities on all the employers and their reported gross payroll for the year. And ABN matching just will automatically spit out who's over the threshold not registered for PAYG. So it's, or payroll tax, excuse me. So it's a pretty easy data match, to be honest, these days. And as Raymond said, we see it time in, time after time. It's the trigger for the audit. And once the audit starts, then they start looking and digging and delving more into the detail. Filling in a registration form is the easy part. It's the audit that comes after that that garners all the interest from the revenue authorities. And that's why, as I said, there was a bit of a lull for a few months when COVID. They pretty much put all their ongoing audits that were there from March, April 20 on hold until about October, November. And then they reinstated those and got going again. Plus, they started new audit activity in the second half of 2021 across all states.
Going on to our fourth place, just outside a podium finish this year, was was the category we call the tax audits, being full, general, combined, being mostly where either they're looking at both income tax and GST, or not being actually specific, but having a deeper look at the broader tax returns.
Yeah, we certainly saw that again, garnering a lot of interest from the ATO sort of post October, November, and that sort of back half of the financial year. But in October 2020, the ATO came out and said, okay, we've had this program on the back burner, but we're going to fire it up and release it now. So from October 2020, the ATO commenced what they call their next 5,000 streamlined assurance review program, which is for high wealth individual client groups that have a combined asset wealth of 50 million plus. So that's 5,000 audits that the ATO said they're going to do in the next financial year, the letter said. So what we saw were so far 3 waves: October 20, Feb 21, and May 21. So obviously they didn't do all 5,000 at once. They've had 3 waves so far as they work through these 5,000 audits, and that had quite a significant contribution into that. Basically 10% of claims that we saw coming out of that category in that financial year. So a lot of them, most of them are still ongoing because as we sit here today,
they're large style audits.
They're large style audits, and they encompass a vast array of different tax areas in those groups.
And the information needed to respond is quite significant.
That's it. We see a lot of claims that cost an available amount just on the information gathering stage, because it's that much. So if you've got a large client group worth more than 50 million, they tend not to have just one entity. There's multiple entities, companies, trusts, and superannuation funds and things like that involved, and they all get corralled into the audit activity. And there's quite a lot of initial information gathering that then gets reviewed by the ATO, and then they drill down and become more specific on any areas they want to look at, like Division 7A as an example. CGT events would probably be 2 of the more key focus areas that they're looking at.
We can't do an update what we've seen last year without really talking about JobKeeper. So it was new. It got all accountants across last year would have felt JobKeeper. The efforts that accountants put into getting their clients registered and making those applications for JobKeeper was just phenomenal last year. And I'm sure most accountants who are tuned into this webcast would certainly be not wanting that time to happen again. It was, our feedback at the time was just, it was quite stressful and mentally draining for that period of time.
That's right. So it was interesting, and I haven't got the graph in this batch of slides, but for a seminar I was doing in May, we ran the same chart up to the end of April 2021, and at that point in time in the financial year, JobKeeper was the 3rd largest category for the year to date. But by the end of the year, it moved down to about 5th, and I think what we saw it was that really high level of audit activity, certainly through JobKeeper 1 and then JobKeeper 2, because JobKeeper 2 had far more stringent criteria to be eligible than JobKeeper 1 did, and it therefore garnered a lot more ATO audit focus before they started paying out, because you had to have your decline in turnover verification, employee eligibility checks with a proof of tier 1 versus 2 tier payments, nomination form compliance. Some of those things were there in the first JobKeeper 1, but certainly the turnover verification and the tier 1 and tier 2 were specific to JobKeeper 2, and that's why there was a lot of ATO audit focus in that. And as we know, JobKeeper payments finished at the end of March, but we are still seeing, I saw 1 or 2 last week, we are still seeing audits coming through where the ATO are still drilling into those turnover verification and tier 1 and tier 2 compliance, and also eligibility of employees. I think they're now cross-referencing and cross-matching a lot of people that were on visas and things like that, who maybe were not entitled to JobKeeper but had been paid it. And I think in the hustle bustle of getting JobKeeper payments out to employers, there was a lot of, let's just get the payments out, we'll come back later and validate anything that we need to. So we're still seeing a bit of that. It's a bit hard to get the money back now. And to be honest, I've seen a lot of claims and audits where the ATO has actually not requested the employer pay the money back, even though they weren't entitled to it for JobKeeper. So I'm not sure if that got out in the public, it'd be received too well, but that's sort of something we were privy to on a few examples. But it is what it is, and that doesn't affect our statistics, if you like. It's just anecdotally something.
And that's more about the outcome, isn't it?
It was more about the outcome. They said, you're not entitled to JobKeeper for this person A, B, C, and D. We overpaid you, make up a number, $10,000, but we're not going to make you pay it back, or we're going to make you pay back $5,000, or whatever. So there was a fair bit of leniency, I think, is fair to say. Call it the spirit of the whole thing, or whatever you want to call it. But it was still being audited, but the outcomes were maybe probably what you mightn't expect them to be.
Yeah. Okay, so if we look at, we talked about this last year, the next point here, but the message and the observation is still as relevant as it was last year, if not more relevant. And that is, whose work is being reviewed more in audits? Now, you touched on this earlier, Rod, when we talked about employer obligation audits. So we both know of accountants who have said that they don't feel a need to have a tax audit insurance program in their practice because they do an accurate job, or they keep their clients under the radar. But let's break that thinking down a bit for our audience here today.
That's right. So if we took the position that for, let's say, probably maybe a larger business, we'll just use an example where the accountant doesn't get involved in preparation and lodgement of the BASs, they don't do the payroll, they don't do the payroll tax returns, they didn't do the JobKeeper applications, they don't control their client super payments, they don't do the work cover return, and no accountant does land tax because it's just an assessment that pops up. So if you add all those categories together, basically 60% of the audit activity came from categories where the accountants, and a vast majority of them have no control or don't do any work in that space other than maybe the annual check of our wages times 9.5% equals roughly the super contributions, or the wages by payroll taxes. So it looks not a bad number. Move on because they're on a fixed fee. The client doesn't want to pay any more than they have to, etc., etc. So there's all these vast categories, 60%, where your clients will be audited and can be audited, where the accountant goes, have you been paying your super, employer A? Oh, well, I sort of got a bit behind with COVID. I paid a bit, but I haven't paid it all, and I haven't paid the June quarter yet. And you kind of go, what are you doing? Why didn't you tell me about all this? And it just spirals out of control and becomes something so much more bigger than it needed to be quite often. And the accountants are left scratching their heads going, really, what's going on here? We've got to work better together so we can stop this happening in the future. But it's too late by then. So they might be able to, you've got to corral the audit that's going on and try to limit the future exposure, but it's not going to happen with every client. So because that's the nature of the beast.
Yeah, and I think it's a pretty important point to underline as we believe we have. So if we're looking at our sample size, we say it's around the 200,000 businesses, or business groups, if you like. And we break our clients down into sort of categories. And so where have we seen these audits being targeted? In what categories?
Yeah, it was an interesting mix. So we look at, and if I go back to the slide before, that you start looking at these sort of turnover categories of businesses, and there's a good chance they're involved in all those things that we talked about before. They'll get in JobKeeper. Well, they have to have work cover. You've got one employee, you need to have work cover in whatever state that you're in. They've got PAYG, they've got super guarantee because they've got employees. So as soon as you start having employees in a business, you're exposed to all those different types of tax areas that can potentially be audited. And where we landed was business groups with 1 to 3 million, your classic sort of SME type clients, or the ones being targeted. 0 to 500, your smaller micro type businesses getting targeted. And then we build up to your 3 to 6, 10 to 25, and back down to 500 to $1 million. So up and down a bit, it doesn't just spike up based on turnover going up. We see audits coming in all those different business group turnovers from 0 up to 25 million effectively.
And if you look at that mix there, Rod, like our mix of what clients take it up doesn't follow that exact profile mix. So
no, that's right.
So we're seeing, for example, the 1 to 3 millions are represented higher than their sort of participation in the program is my assessment, and certainly the 3 to 6 is certainly as well. And surprisingly, the 500 to 1 million is sort of where it is on that. But yeah, that's so it definitely doesn't match, and that's the point we're trying to make here, that it doesn't match just the straight take up of which clients are actually taking up audit cover, Autoshield through their participation. There's genuinely a focus in there that's been developed. Okay, time to check that we haven't lost our audience to the Olympics. Our next poll question is: where do you predict the ATO and the other state and federal government revenue authorities will focus their audit activity in the 2021-2022 year? 4 choices here. Employer obligation audits and reviews. If you've been listening, that'd be interesting to see how if you picked up on any clues that Rod's already given on this. JobKeeper payment audits and reviews is B. Our next 5,000 streamlined assurance review program is C. And just the general other, if none of those are your fancy. Now, please remember to hit that submit button on the bottom right-hand corner. It's a little bit hidden, so we're hoping that was the reason why the results came in on the first poll along those lines. So anyway, so whilst we're waiting for some of those polls to come through, and let's get back to the Olympics really. So the Boomers did look a little bit scratchy yesterday against Nigeria, I thought.
Yeah, that assumes I watched it, Roman. But so that's all right. I was watching my beloved Bombers get pumped by GWS, but I did hear the Dream Team going down. So that was they lost all their preliminary games. So they look like they must have a bit of infighting or something going on there, yeah. or don't really want to be there or something.
We'll see whether they can turn it on. But the interesting fact that I read this morning was that the Nigerian team has the second most NBA players in its team. So the second most compared. Obviously, the first one is the US Dream Team. So maybe it wasn't such a bad result beating Nigeria there. Anyway, results are in, and Olympics wins, I think, is the summary out of that.
2 for 2.
2 for 2 for the Olympics. But of the people who have voted, the employer obligation is their tip, with JobKeeper coming in second.
I gave you the Rod's prediction early. Unfortunately, it snuck in, but I think that means people listen to it, so that's good. So they've honed in on that.
Okay, so we've talked about what we've seen in the past. We've got the poll results now for what the audience believe will happen in the next year. So it's I know you like putting your neck out on the line with the predictions about the future, and I've got to say, to give you a pat on the back, if anybody was to put some money on the tab for your predictions of last year, I reckon their betting accounts would have been in a better state than what they probably are now without that. So
we only promote responsible gambling on this webinar, Roman. That's
of course, yeah, responsible gambling, yeah.
That's all I've done in lockdown is responsible gambling. That's right.
Yes, yeah, the tab's got some of my responsible money too. Anyway, let's start to look at your thoughts for next year.
That's right. So employer obligations is my predicted biggest claim category heading into this current 2022 financial year. JobKeeper payment audits and reviews. It's really a crystal ball on JobKeeper. As I said, we're still seeing some audits coming through, but the money's been and gone and been spent. So my prediction is it's not going to be a top 5 maybe in 2022 unless JobKeeper 3 gets a run. So We now have JobSaver. Everyone comes up with these nice new names. That's not JobKeeper, that's JobSaver. It's being run by state government departments, not so much the federal. There's all sorts of COVID things going on now off the back of the New South Wales and Victoria in the latest lockdown. So there's a bit going on in that space, but we only cover JobKeeper, being from the ATO, as we'll drop into that a bit more detail. The next 5,000, well, if they work their way through 5,000, that's probably going to be, again, through this financial year, we'll see those continuing to go. And then in the other, we'll come to that. There's a few specific programs that the ATO are running at the moment. So if we flick onto the employer obligation. So just by way of a bit of background, those that do or don't know, there was a superannuation guarantee amnesty that was commenced in, I think, February 2020, after probably 2 or 3 years of stuttering and stalling at the political level before it got up. It had a window, and that window was from about Feb 20 through to September 20. Couldn't have been the worst timing in hindsight ever, with COVID coming bang smack in the middle of it. So I think many thousands, I'll use, of employers that were maybe potentially going to utilise the SG amnesty to clean up their sins of the past and all their unpaid super guarantee going back for many years, didn't do it because of COVID. They're unsure where their business was going to go. Their business was suffering. They weren't going to use that excess cash that they were storing away because the rainy day came, and the rainy day was COVID. So the SG amnesty didn't have the effect that one hoped it would. And therefore this unpaid super from many years ago is potentially, well, not potentially, it's still there. So as well as, I think, unpaid super probably for the 4 quarters to June 21 off the back of COVID, there'll be a lot of employers that didn't pay their super. They may have had a great intention to, but COVID and cash flow just meant that it didn't get done. So the ATO is not going to let that go away. There might be a bit of a grace period, but they're all going to know who they are from the single touch payroll reporting for the most recent year or two, if you like. So I'm under no illusion that it's going to be audited pretty hard this financial year. We also saw a bit of a sleeping giant come out in September 2020. The ATO finalised a practice statement 2020/4, and it got a little bit of publicity in the sort of accounting press, the CPA, the CAs, and Tax Institute, etc. But it was just passed and put in practice, and I don't think people realise the significance of the penalties that are attached to it. Basically, if you pay your superannuation guarantee late, you're obliged to then lodge SGC statements. And under this practice statement, if you don't do that and then the ATO audits you, the penalty is basically a minimum of 100% of the SGC payable, irrespective of if you paid the super late. So it's a sleeping giant that I don't think people are really aware of now. And the audits that we've seen, the ATO's hands are tied now. They have to administer superannuation guarantee audit activity and the penalties based on this practice statement. Now, I did see there's a review going on in June that's still to be finalised, where I think they're looking to maybe reduce some of the penalties that are so harsh, but it's definitely a sledgehammer to crack a nut approach now. We're seeing it coming through. So it actually resulted in us making a change to our policy. We still have a exclusion for ATO penalties of 75% or more, but that basically meant every superannuation guarantee audit was potentially going to be excluded, and we saw them starting to be excluded. So we managed to have our exclusion for super guarantee changed to more than 100%, because the majority of them we're seeing are that 100% level. So we've made that change, and that'll certainly help all our accountants, policyholders going forward.
And I think we'd like to, at this point, thank the likes of Vera, who are a provider, for working with us and understanding that that we are living in a dynamic environment at the moment. So when JobKeeper came up, we went to them and said, hey, this is evolving. This is important to have it, make sure that our accountants and their clients are covered through this activity. And they came in and helped us. And certainly when we presented to them this change in practice approach by the ATO on this on the super, and explained to them that the scenario. And they've come to the party again and sort of said they could see the bigger picture with us, which is really good. And so we thank Vero for that long-standing understanding and the support that we have with them on this. Now that and we talk about the penalties, and you mentioned 75% is what's in there for all other ATO audits, none of the state revenue audits, but the ATO audit, that 75% is intentional disregard for the law, and so that's a pretty high watermark for culpability penalties. And realistically, just to put that in perspective, how many have we seen over the journey for outside of the recent super one? In
it would be a very, very small percentage, and they're always accompanied by a very interesting story in the ATO position paper or reason for decision, I must say. So they're the ones I like to read, actually, because they've always got a bit of a story behind them. And look, but also if the accountant and their client are successful in objecting to those penalties and get them below 75% on objection, then we still cover the whole audit and the whole claim. So that's quite often a good result, because a lot of accountants do object to the sort of ATO's first hardline position of high watermark penalties. They don't just go, oh yeah, fair enough, let's pay that and move on. It's very rare that there's not an objection. Not always successful, but they certainly try for their clients.
Okay, JobKeeper, what do you see going forward on that?
As I said, we've already probably talked about it a fair bit as we've gone through. We're still seeing audits. I expect to see a few more. It's really dependent on what happens in the JobKeeper space. ScoMo and Josh Frydenberg no, and no every day of the week, because they're being asked about it every day. So there are other programs in place now that we talked about. So I don't see JobKeeper being as big as it was, but it's still there, and I still expect to see JobKeeper payment audits and reviews going on for certainly this financial year at least.
Well, you see that there's nearly 1 million businesses registered for JobKeeper. There's a fair bit of it out there.
And I mean, we saw there's a couple of grabs from Accountants Daily articles there. We saw, the ATO clawed back 155 mil or 135 around about Feb. So they would have clawed back a bit more since then. So and of course we saw those some businesses handing back their JobKeeper at times. That's not an audit, obviously, but and if they're entitled to it, they're entitled to it. So it has got a lot of press, a lot of space, JobKeeper, and we still keep hearing about it. So we have an endorsement on our policy for JobKeeper post-payment, which we're coming up to now. So given JobKeeper payments finished at the end of March, every JobKeeper audit now, in theory, would be post-payment. So if there was an audit now, it would be covered on face value, one would think, because all the payments have been made.
Let's see what happens with the JobKeeper 3.0 gets a run or not at the moment. So
if it does, we'll deal with that at the time.
Yep. Very good. Okay, so keep hearing about and reading about next 5,000. So run us through that.
So, as I said earlier, individual high wealth private groups worth $50 million or more in assets, not turnover, assets. So you can be asset rich, but turnover poor, as they say, and you can still be caught up as part of this program. So that's at least 5,000 audits that we know about that are going to commence after October 2020, pretty much. And most of the letters say in the next financial year, but we'll contact you in 3 months and give you a timeline. So the ATO put out a roadmap. It's a lovely diagram, says where you are on the roadmap. Step 1, so they write to the accountant, the tax agent, and tell them these are your clients in this program. So they're already on notice that they're a part of the program. They're under audit or review. At that point in time, you don't have to do anything until the ATO come back, which we normally see is within 3 months, and start the actual program. As we said earlier, they're all encompassing. They cover every entity in that private high wealth group, including their super funds, and they want financial statements, tax recs, loan agreements, CGT transactions. There's an endless list of things that they want if it's specific or required as part of that group. And that's just the information gathering phase before they get specific on what they want to look at. They want to have a meet and greet. They want probably more phone meetings now, or Zoom, or whatever meetings, not so much physical anymore at the moment. But there's a program, there's a roadmap, there's steps in the process, and they all go through it. I don't think they've got too many wrong in terms of qualification. Anecdotally, out of all the ones we've seen to date, I only know of one where the accountant's argument was, my client's not worth 50 million, and they proved their way out of it. That's one out of all the claims that we've seen, and we've seen a lot of claims in this space so far.
So what other areas target ATO review do you see coming up in the 2021-22?
Okay, so I've listed down 4 bullet points, and the ATO is just giving me these gold nuggets day in, day out, week in, week out. For those accountants and people on this webinar who subscribe to Accountants Daily, which is sort of the go-to daily, call it magazine or daily bulletin for accountants of what's going on in the industry, every day I see something that we go that sort of helps us, if you like. But cryptocurrency, there's going to be a time, and it's coming soon. I think the ATO has been sitting back and waiting on crypto. We haven't seen a lot of audit activity in that space yet, but they came out in May and said, righto, we're on to cryptocurrency now. We're going to be writing to 100,000 taxpayers that we know have got crypto assets, explaining their obligations and urging them to review previously lodged returns, or I think what they're going to put in their 2021 tax return. So I think it's probably a warning, alert, information, call it fishing expedition campaign, which is not an audit at this stage, but whenever they do that, they already know a lot about that taxpayer. So they're sitting back waiting to see what gets lodged in that taxpayer's tax return on the crypto space, and then they'll pounce if they don't like what they see. I think that's a given. Rental property expenses, again, we saw a campaign towards the back end of the financial year, warning, alert, make sure you got the right expense records for your rental property expenses. We see your claims are up. Are they in line with the norms, things like that. So it's, again, a key focus area. Now, work-related expenses. Everyone knows this is going to go through the roof in claims made for the 2021 financial year. We have the what is it, 80 cents an hour simple method. But when you dig into the simple method, most things I've read say you're better off going with the actual method and get you a bigger claim, but you better have the records ready if you're going actual versus simple. So it is going to skyrocket, and I expect the audits to come thick and fast on the back of it. So how you got to do? You got to prove you're locked up, working from home. All sorts of queries are going to come. I'm sure there'll be a questionnaire designed around it.
Question without notice, Rod. On your tax return last year, which way did you go?
I actually started doing my return this year, and I decided to claim nothing because I couldn't be bothered with it. And I said I'll just stay off the radar. Okay. But you know what the flip side of that is? You wouldn't want to be claiming the same amount of car expense motor vehicle that you claimed last year if you're ramping up your home office expense claims. Yeah. But I know people will. They'll think, oh, I need money, I need money, I need money. I was 4,800 kilometres last year, never claimed 5,000, listen for any mug punter. But I wouldn't want to be claiming it this year unless you're an essential worker or something like that weren't affected. But I think accountants, if they're doing their own return like mine, I just couldn't be bothered with the home office claim, to be honest. Yeah, just like not worth the hassle for a few extra bucks. But
I went the simple method. I took my bucks. They offered it, I took it.
So I did pull my car expenses less than last year. There you go. There you go. So they will be looking at that like hawks on tipping. The other one is gig economy, your Airbnb, your Uber drivers, all that sort of thing. Again, there's more data, rental property data, stuff like that. The data matching programs are now in full swing with the tax office, having oversight over all these areas now. So expect the audit activity to increase exponentially in all of these areas, I think.
And we've seen as recently as I think yesterday or this morning, where the ATO every year, let's be honest, the ATO every year has a program where they do it well, where they make sure that everybody knows that they're out there. As people are preparing their individual tax returns, they make sure that everybody's aware that they're there. And the recent ones, you know, as much as yesterday and today, hearing about this supercomputer matching that, be careful what you put in your return because they're getting all this data and all that. So it's their typical program to make sure that the people are sort of aware that they're there before they file their tax returns, and just to be conscious. And they've been running that program probably since at least 2010, I think, from my memory of trying to make sure prevention is better than cure was the program that they initiated way back when, and they've been strong on that. Their messaging has been pretty good, I think, as far as making people aware just to do the right thing as they're preparing the returns, rather than have to chase them at the end.
And plus, we see a lot of accounting practices being audited themselves when that tax agent's practices client claims for things like work-related expenses are outside the norm when compared to others. So there's a lot of tax agent accounting practice profiling gets done by the ATO as well, which invariably leads to audits of their clients. So it's another key sort of driver the ATO use.
So I know we've looked at the whole of last year, but are there any developing trends areas during the last part of last year that you think will just flow into this year?
Yeah, well, I think we're breaking it down a little bit. I know for our payroll tax, we sort of did an Australia-wide position, but for the first 6 months of 2021, we saw basically Victoria and New South Wales being most active. I'll probably say New South Wales will be the least active in the next 6 months for obvious reasons. So that's just a timing thing. Maybe Victoria will ramp it up again this week when we get out of lockdown 5 with a bit of luck, but who knows? Work cover, we saw a spike in WA work cover audits as well. Work cover audits in New South Wales and WA in that 6 months of this calendar year. And then we did see a spike in rental property reviews over April, May. Why is that? Because a vast amount of taxpayers lodged their returns towards the end of the tax agent lodgement program in your May and June. And that then created a bit of a focus on repairs and maintenance and things like that. Less rental income, but higher claims. So if you reduce your rental income because you didn't have a tenant, but your repairs and maintenance goes through the roof, then that's another key red flag for the ATO, capital versus repairs and maintenance type audit activity.
Especially while the property's been empty in theory when you've got no tenant in it.
That's right. And, I'll just go repaint it or something like that.
Yeah.
So when I'm putting in a new kitchen.
Yeah, exactly. So so you talk to way more accountants than I do nowadays, and you mention me often that in your view some accountants are missing some opportunities to make claims because they just didn't know they were covered. So what are these areas?
Yeah, I think the main one I always find is this sort of perception that tax audit insurance only covers audits. So unless I can see the word audit on a letter or an email or document, then it's not going to be covered under an Autoshield or a tax audit insurance program. That's not true. Certainly from Autoshield perspective, we have a very wide definition of what we constitute and call an audit, from reviews, inquiries, examination, investigations, whether it's as simple as a phone call from the ATO, ringing the tax agent going, oh, I see Raymond's home office claims gone through the roof. What method was he using? Or he's ticked the box to say simple method, but we've got a few more questions for Raymond because We tracked him on CityLink, and he went to the office every day during the lockdown. I make up an example.
I don't live on the CityLink path, so
anyway, so that. Oh, would that be covered? Yes, it would. Now, what document you got for that? Absolutely none. But you spend 40 minutes on the phone with the tax office auditor going through the return and a few other questions. That would be covered under Autoshield. So reviews, there's more reviews than there are audits if you want to break it right down. Quite often the review stage and the inquiry stage is the initial phase. Then the ATO may expand it to an official audit, but all the steps in the process are covered certainly under Autoshield. Again, our data matching. So we quite often see the ATO amending assessments or amending returns once the accountant lodges them and changing the numbers in interest or dividends or things like that, because the ATO's got other data. They've got the data from the bank or the share registries showing different figures, and they'll just automatically change and issue an assessment that's different to what you thought it was going to be. So if that's a data matching change, again, you won't see the word audit on the assessment. It's just a data matching change. So we cover that sort of thing. We cover excess super contributions, tax assessments. I call it the free steak knives. You won't find the word audit on there as well, but we've been covering them ever since they started. Not Div 293 or transfer balance account, just excess super contributions, tax assessments. Pre-engagement, pre-lodgement reviews. Quite often now, the ATO's got wind of a large-scale transaction. They're normally a CGT event, and they'll start a pre-lodgement, pre-engagement review with that taxpayer about what they're going to put in their tax return before they put it. It's got everything's the same as any normal audit. They just haven't lodged the return yet, so they're basically doing the audit up front. But we certainly cover that as well. Plus Fair Work Ombudsman. Look, we don't cover complaint and dispute resolution matters, but we certainly cover Fair Work Ombudsman doing an employer wage audit of all the employees of a business for like 2 weeks or 4 week pay cycle. They come in and they look at all the wage records. They tend to target certain industries, certain areas, and we cover those as long as it's not a complaint or dispute resolution.
Very good. So here's our little chance to plug our business quickly, and I'll only be quick. So Autoshield as a win-win, no net cost solution for your accounting firm to protect your clients from additional costs relating to those audits. And we say win-win, being both you and your clients benefit from having something in place. And also, don't be fooled by people selling tech solutions in this space. Tech solutions always take your internal time for people to manage them. Autoshield not only has the tech in the background, but provides the actual people up front to keep making it happen for you year after year. Okay. Yeah. So why do people take it up? Pretty much these are the reasons why accountants like them. Reduced fee write-offs that accountants may take. Facilitate prompt payments. Rod, you were in practice. I was in practice. An honest statement. How were your clients paying your bills versus how quick we pay Autoshield bills?
We got the debt collector to hassle them,
Yeah.
or I rang them up.
Yeah, we're pretty slow, weren't they?
Yeah.
No, we're pretty good. So we say 14 days. We generally pay within 7 for all these claims. Removes potential disputes with clients. It's easy. You don't have to. You basically say you and your clients are on the same side of the table all the way through this. Cost is irrelevant to the service you provide. Proactive in providing clients with a solution to a potential problem, and it's a cash flow positive solution to your clients. Talking about tech, as we were earlier, if you want to have the information in your hand, you can. Handy for partners who don't want to be plugged into the web portal. This app provides quick, simple, easy to access information. And if you're a client of ours, ask your account manager and they'll show you the value of the app that we do. Finally, so our marketing team, James is no doubt listening in. So I've gone all out on this slide with the tagline, Accountancy Insurance provides comprehensive cover you can count on. So true, albeit a little bit hammy with the play on the accountants. And but anyway, that's true. So so we're up to our question time. If you haven't already, please type your question in the question pane on the right-hand side of your screen. We've got some question updates about Ash Barty, lost the tennis. Sorry, we didn't mention that earlier on. It was on my list to mention, but Steph Gilmore's departure probably was more current, I thought. But anyway, so we're open for questions.
Okay, thank you both, Roman and Rod, and you've actually taken up the allocated time. So we haven't had any questions come through as yet while you were just summarising there. So I'll ask one very, very quick question, if that's okay, and it's just around the new wage theft acts that are being raised at state levels, and for example, New South Wales is focusing on unpaid wages in business, where Victoria focuses more on the criminal side of it. If accountants get involved, are they covered?
I'll say depends. On face value, yes. I mean, wage theft is probably the buzzword of the last couple of years. And as you say, most states have introduced a wage theft act now. But if it's, I'll relate it back to our Fair Work Ombudsman. If there's a state government, state revenue office doing audits of an employer's wages around wage theft, have they paid their employees the correct amount of wages under the awards and financial conditions that are relevant to that industry, and they're looking at all the employees of the business, then on face value, yes, it would be covered. But if it's some criminal investigation, I'll say probably not covered, because we do have an exclusion for criminal activity. So it'll play out, but if it's along the Fair Work Ombudsman type audit line, then potentially yes, as they come through.
Okay, that's great. All right. Well, we've had nothing else come through, so we just might wrap it up there. Just thinking about time. So, thank you once again to yourselves for this presentation today, and to everyone who has attended. I will now hand it back to Lauren.
Thank you, Kristen, and thank you, Rod and Roman, and thank you to everyone for your participation. In the next 3 working days, you'll receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback, as it is extremely valuable to CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.